factors contributed to the U.S. stock market's performance this year, despite facing significant turbulence?
According to Stan Show from the Associated Press, the stock market experienced a scary good year. Despite worries about tariffs, interest rates, and a potential AI bubble, the S&P 500 index funds still managed to return over 18% through December 11, marking the third consecutive year of substantial gains.
The article mentions tariffs causing market tremors. Can you elaborate on how President Trump's tariffs impacted the stock market and the broader economy?
Trump's tariffs triggered concerns about a potential recession and rising inflation. The S&P 500 experienced its worst day since the COVID crash, and the U.S. dollar's value declined. The U.S. Treasury market also felt the impact. However, a temporary pause in tariffs and subsequent negotiations helped to calm investors' nerves.
What role did the Federal Reserve and its policies play in the stock market's performance during the year?
The Federal Reserve's independence was tested as Trump pushed for lower interest rates. The market received a boost from 3 interest rate cuts by the Federal Reserve, contributing to a calm summer for Wall Street, alongside the artificial intelligence enthusiasm and strong company profit reports. In summary, the stock market's resilience in 2025 can be attributed to factors such as the Federal Reserve's rate cuts, the artificial intelligence enthusiasm, and the ability to navigate and, at least temporarily, overcome challenges posed by tariffs and trade tensions.
Thank you for providing those. What's influencing the stock market as we approach the end of the year?
Karen Fryer's analysis highlights a few key factors. U.S. stock futures remain steady, and Wall Street is hopeful for an end-of-year rally, with the S&P 500 eyeing a fresh record. Recent data, including a surprise drop in inflation, has kept bets on future interest rate cuts intact.
Are there any important economic indicators to consider?
Absolutely. The third quarter GDP data offers insights into the economy health. Additionally, the December Consumer Confidence Report is crucial, especially given the narrative surrounding the K-shaped economy among American shoppers.
Any specific companies making significant moves?
Yes. Novo Nordisk's U.S.-listed stock jumped following FDA approval to market its Wegovy weight loss pill to self-paying customers starting in January. Also, Huntington Ingalls Industries experienced a stock rise after securing a U.S. Navy contract to design and build a new class of warship.
What's the overall outlook for the stock market considering these factors?
The stock market's performance appears cautiously optimistic, driven by hopes of continued gains and anticipations surrounding interest rate cuts. Monitoring upcoming economic data and individual company performances remains crucial for investors.
Thanks for the insights. Which cash-heavy stocks should investors consider, and which should they avoid?
Anthony Lee's analysis sheds light on this. While financial resilience is key, a large cash reserve alone doesn't guarantee a strong investment. The analysis pinpoints Dexcom as a promising stock due to its sustainable growth. On the other hand, it advises caution with Twilio and Carrot Packaging, citing specific growth and profitability concerns.
What makes Dexcom a sustainable investment option?
Dexcom, established in 1999, specializes in continuous glucose monitoring systems, which have transformed diabetes management. This focus has enabled consistent growth and a strong market position.
What are the concerns regarding Twilio and Carrot Packaging?
Twilio's average billings growth has been underwhelming, and its sales growth projections are sluggish. High servicing costs impact its gross margin. For Carrot Packaging, revenue growth hasn't met expectations, and earnings per share have fallen due to new share issuances. Its weak free cash flow margin also limits investment and shareholder returns. In summary, the analysis suggests investors prioritize companies with both financial flexibility and strong growth prospects, while carefully evaluating those with sluggish growth or profitability issues.
Thank you for these insights.